Good afternoon, and thank you, one and all, for joining us today at the 12th Annual Inland Empire Economic Forecast Conference. I'm pleased to be your MC. My name is Dave Robinson. In addition to being enormously proud to be a UC Riverside alumnus, I'm the executive partner of the Orange County office of Holland & Knight, a full-service law firm with over 30 offices around the globe. I'm also honored to serve as the chair of the UC Riverside School of Business Dean's Advisory Council. I welcome you all. As the only research-based business school in inland Southern California, UCR School of Business is deeply committed to creating sustained and equitable economic growth in our surrounding communities. An important part of that mission has been to establish the Center for Economic Forecasting and Development, and together with the center, to host this conference. This highly anticipated annual event is all the more important this year as we continue to shake off the lingering effects of an unprecedented crisis and hopefully begin to see the light at the end of the pandemic tunnel. Before moving on, I'd like to take a very important moment to thank all of today's sponsors. Their generosity has made this annual conference possible year after year. We're delighted to announce new sponsorship partners and welcome back returning sponsors, a number of whom have supported this event almost since its inception. First, a very deep message of gratitude to our gold sponsors. Pacific Premier Bank, now at 11 years of sponsorship and part of a multi-year partnership that supports the conference. The Riverside County Economic Development Agency, a 10-year partner and sponsor of the conference. Bank of America, who sponsored the conference for 9 years and is being welcomed back to this year. And I'm particularly pleased to welcome and give thanks to a new gold sponsor, my firm, Holland & Knight LLC, joining us for the very first time. We're deeply grateful also to our silver sponsors, SolarMax Technology, now in their 9th straight year of sponsorship, the KPC Group, supporting this event for the 4th year, and Altura Credit Union, now in their 3rd consecutive year of sponsorship. And a big thank you to our bronze sponsors, Provident Bank, a sponsor for 11 years, the City of Ontario, now in its 4th year of sponsorship, Hub International, joining us for the 2nd year, and Schools First Federal Credit Union, also in their 2nd year supporting the conference. Among our media sponsors, we thank Cola FM, who has supported the conference for 5 years, the Inland Empire Business Journal, joining us for the 3rd straight year, and we'd also like to acknowledge our in-kind partner, the Inland Empire Regional Chamber of Commerce, whose promotional support has helped this event grow. Thank you again, one and all, for your continued commitment to UCR business, the center, and the economic success of our entire region. Without your support, this event and its important connections to the community simply could not happen. Well, what a year, what a year, what a year. In truth, it's been nearly 2 years since COVID-19 became a household word. Do you remember when we were all still trying to figure out how to spell COVID? We've all endeavored to adjust and readjust throughout the pandemic. I can't think of many topics that have baffled, perplexed, and surprised people more than the many unforeseen twists and turns our economy has taken. Today, we hope to provide some clarity and even some good news about the most pressing developments facing the current economy, such as inflation. When will it end? The labor market. Why can't businesses across our country hire with so many people still out of work? supply chain disruptions. I'm sure you've all seen the pictures of the dozens of container ships parked just off our shore, and a host of other issues. Additionally, we'll be looking at the direction of the United States, California, and Inland Empire economies will take in the next year and beyond. Presenting the economic forecast are Dr. Christopher Thornburg, Director of the Center for Economic Forecasting and Development, and Research Manager Dr. Tanner Osmond. Following their presentations, Research Manager Dr. Patrick Alder will talk about one of the most hotly contested post-pandemic debates: are dense downtown areas really dying? You may be surprised by what you hear. Since its launch in 2015, the School Center for Economic Forecasting and Development has built awareness about the Inland Empire's economy, which, for a little perspective, makes up an economic area larger than Detroit, Seattle, San Diego, and Orange County. For 12 years now, this event has helped grow and support the region's economy by building an accurate understanding of its key strengths, challenges, and future, and by serving as a platform for voices across business, government, and the community. This afternoon, in line with these goals and traditions, we will bring you new insights, solid analysis, realistic forecasts, and hopefully some optimism about the future. With that, and before we move to our forecast, I'd like to introduce Chancellor of the UC Riverside, Dr. Kim Wilcox, who will be making brief comments. As UC Riverside's Chief Executive Officer, Chancellor Wilcox oversees a campus of more than 26,000 students, 850 faculty members, and 4,700 academic and administrative staff members. During his tenure, UC Riverside has seen historic growth across its education, research, and public service missions, including record improvements in student success, research funding, and philanthropic giving, as well as the establishment of a new schools of medicine and public policy. Please welcome Chancellor Wilcox.
When a lot of people think of a university, they think of a place that students go to take classes and learn and get a degree. And that certainly is what we do. It's probably the most visible part of our operation. But that's not what universities are. Universities are places that create and disseminate knowledge. Create and disseminate knowledge. If we didn't have research, there'd be nothing to teach all those students. And while classes are a key part of our dissemination responsibilities, again, arguably our biggest part, and the part that we're most known for, they're only part of our dissemination activities. We have an art museum, that's a dissemination activity. We have lectures on campus, dissemination activities. We bring grade school and high school students to campus, dissemination activities. And we have conferences like this summit that are designed to help our region achieve even more economically, a key part of our dissemination responsibilities. So today, you get the best of the university. You see the knowledge we've created and presented in a way that we believe will help everyone here in the Inland Empire achieve even greater economic success in the future. Wish I could be there to say hi in person, but of course we're still in a virtual world. Hopefully next time we can actually shake hands and say hello. Good luck with the meeting.
Thank you, Chancellor Wilcox. Now we'd like to invite the Dean of the UC Riverside School of Business, Dr. Youngsing Wong, to make a few brief comments before jumping into our program. Dean Wong joined the School of Business in 2008 as the Dean's Distinguished Scholar in Supply Chain Management and Professor of Finance and Management. An internationally renowned scholar, in 2014, Dean Wong was named Dean of the School of Business, home to the A. Gary Anderson Graduate School of Management, after serving as interim dean since 2011. I have personally observed Dean Wong bring tremendous leadership and growth to the School of Business. During his tenure, the school introduced a master's in finance, a master's in professional accounting, a master of science in business analytics, and is now preparing to launch an online MBA. He has championed initiatives that enhance engagement and collaboration within our community and for the benefit of business leaders in the region, including the Dean's Advisory Council, the Dean's Speaker Series, and the Executive Fellows Program. In addition, the school is planning stages for its new state-of-the-art building, underscoring the school's upward trajectory as a top institution for global business research and education. Please welcome Dean Youngseen Wong.
Thank you, David, for that warm introduction. On behalf of the UC Riverside School of Business and its faculty, staff, and students, I would like to welcome you to the 12th Annual Economic Forecast Conference and our second virtual conference. I would also like to extend my gratitude to the many sponsors, without whose support this conference would not be possible. Our returning sponsors, our new sponsors, and our media and in-kind sponsors. These long-standing partnerships and their contributions to this important economic conference and to the School of Business are invaluable. Each year, this conference offers a unique opportunity for members of the Inland Empire community to gather and learn more about the most important issues affecting the economic health and the future of our region. We are fortunate to have top researchers and economists leading our UCR Centers for Economic Forecasting and Development. Today, they will break down the leading indicators and other data and share an insightful forecast for the coming year and beyond, including what is going on with the global supply chain, the labor market, and the inflation. The Inland Empire continues to be a region of tremendous growth opportunities. Report after report produced by the Center shows that the Inland Empire has significantly outperformed the nation in business activities. We are also grateful for the many partnerships we have across the Inland Empire with the counties, the cities, UC Riverside, and the region's business leaders, all working together to provide resources and build the networks that support innovation and business growth. Through our Center for Economic Forecasting and Development, we are committed to providing the research and expertise that will continue to inform public policy, decision-making, and promote economic trend and growth throughout the region. Thank you, and enjoy the rest of the conference.
Thank you, Dean Wong. And now the forecast. A quick reminder, at the end of the program, we will be holding a 15 to 20-minute question and answer session. At any time during the presentation, please feel free to submit a question by using the Q&A option that appears in the bar at the bottom of your screen. We'll attempt to answer as many questions as possible, and apologies in advance if we're unable to answer all questions due to time constraints. It is now my pleasure to introduce the Director for the Center of Economic Forecasting and Development, Dr. Christopher Thornburg, who will be delivering an outlook for the United States and California economies. An expert in economic and revenue forecasting, regional economics, economic policy, and labor and real estate markets, Dr. Thornburg has consulted for private industry, cities, counties, and public agencies in the Inland Empire, Los Angeles, San Francisco, Seattle, Sacramento, Nevada, and other geographies across the nation. He's also an adjunct professor at the UC Riverside School of Business. Please welcome Dr. Christopher Thornburg.
Good afternoon, everybody. I'm so glad you could be with us today. My name is Christopher Thornburg, and I am the director of the UC Riverside Center for Economic Forecasting and Development. And I am, yet again, thrilled to be with you to give you some sense of where the overall economy is heading. There's a lot to talk about, and we still have to get into the local situation and some issues about economic development. So let's dive right in. To talk about where our economy is heading, I first have to go back in time about 18 months ago. If you remember, 18 months ago is when we started to realize that the severity, the potential severity of the COVID pandemic was the real deal. The number of cases, the number of deaths in the United States started to go up quite sharply, and there was a lot of unknowns. How bad was the disease? Would we be able to have a vaccine? How long was this thing going to last? Clearly a lot of uncertainty. But what was interesting was how that uncertainty, of course, translated into what I would call an almost economic panic about what it meant for the overall U.S. economy. And here's a selection of those headlines you saw last year. Home prices are going to fall. 30 to 40 million people are going to be evicted. The worst downturn since the Great Depression. One of my favorite quotes, make no mistake, the pandemic has morphed into a depression-like crisis. Boy, I wish I could take that economist, put him in a time machine, and send him back to 1931 to see what a depression actually looks like. Now, it shouldn't be too much of a surprise that we took this turn in terms of the conversation about the economy. After all, if you've been attending our sessions over the course of the last few years, you know that one of my kind of catchphrases is the term miserableism. That is to say, the philosophy of pessimism, or constantly try to tell everybody things are worse than they actually are. If you think about the last 5 or 6 years in the U.S. economy, we have been subject to all sorts of incredibly negative headlines, despite the fact that the data showed us that the U.S. economy actually has been a very good and healthy growth trend. So not much of a surprise that that turned into these panic points. Now, where are we right now? How do we think about the economy after these 18, 19 tough months? Well, here's kind of a big picture, if you will, of where this presentation is going, and then we're going to, of course, dive into the data. Number one, the U versus V conversation. You know, as we said last year when we first started talking about where the economy was heading, there's no doubt that the pandemic is a tragic situation. 5 million people worldwide have lost their lives. That number will continue to climb. Our hearts have to go out to those families. But with that in mind, history shows us clearly natural disasters do not have the same long-run consequences that typical drivers of economic recessions do. In other words, as bad as this was from a natural disaster standpoint, a quicker than normal recovery was almost certain. Now, that wasn't the political conversation. Look, last year was already an incredibly contentious political time. Indeed, so is 2021. But with that in mind, you throw that into the miserableism, all these crazy negative headlines about what the economy was going to do, and what you saw was one of the most overwhelming levels of stimulus you could have ever dreamed of. Over $5 trillion in spending on the part of Congress, $4 trillion in quantitative easing and climbing by the Federal Reserve. This has absolutely set the economy on fire. This economy is just up at this particular point in time, because ultimately all this stimulus has generated $29 trillion in, well, household wealth. Lots of public money has created lots of private sector wealth, and this is candidly overheating the economy right now. Now, overheating the economy, what do I mean by that? Well, for example, we're about to go into a period of time where people are going to be consuming at an excessively high pace, and asset markets also are very hot right now. Home prices are going up at a very rapid pace. But as much as to say, for example, we should worry about the fact that the stock market has the second highest PE ratio, at the same time, low levels of private sector debt means that the risks of these private asset markets aren't as great as, say, they were back in 2005 and 6 when we had a ton of private sector debt. Now, it doesn't mean we're in a new risk-free expansion, as the case may be. The problems we have today are much different than when we saw in the run-up to the Great Recession. This time around, the risks in our economy have shifted, of course, to the public sector. You had a huge amount of new public debt that has been created over the last 20 years, and at the same time, the Federal Reserve is creating an incredibly high risk of really major inflation in our economy. You put those two things together, and the only real question is, when do these things break, and how bad will, of course, the deflationary effects of the reverse policies to fight these things off will be for the overall economy. Now, when you think about our economy right now, you've been hearing a lot about supply chain effects, whether you're talking about the problems at the port. Let's keep something in mind. This recovery that we've seen has been very uneven, and this has a lot to do with the nature of the economic shock and the excessive degree of public stimulus. One of the results of that is some parts of the economy are operating at levels that they were just never designed for, and that is creating supply chain issues across the board, and yeah, a lot of increase in prices for a lot of those commodity inputs. But this isn't a threat to the current path of the economy. If anything, it's a drag on our current path of the economy, which may be a good thing. Perhaps it will prevent this economy from getting too overheated. That remains to be seen. And of course, last but not least, in terms of thinking from the long run, what does the next 10 or 20 years look like? What have we learned from this pandemic? Well, here's one thing I learned. I learned that the term new normal is widely overused. It's worth keeping in mind that epidemics have been with humanity since the dawn of civilization, and the idea that this time around is to create some fundamental change in our behavior doesn't make a lot of sense. But there's no doubt that the pandemic has accelerated underlying trends that are already in the economy, such as labor shortages and work from home, and these are things we will have to respond to from an overall growth and economic development standpoint as our economy continues to move into the future. So a lot to talk about. I got too many slides. I'm going to jump right in, bounce through things, and then again, we'll turn it over to Tanner, and he'll bring you through the local situation. Now, again, going back 18 months ago, the big debate was U versus V. I'll let the data on the right-hand side stand for itself. Clearly a V. The economy has bounced back quite rapidly. Now, we did see a 2% growth rate in the third quarter of the year. And a lot of folks are worried, what does this mean for the recovery? Is the recovery slowing down? Well, actually, I would be clear to say that from a recovery standpoint, we're already done with the recovery. And what do I mean by that? Well, on the right-hand side, you'll notice I have two lines. The top line is final demand. It's gross spending by consumers, businesses, and government in our economy. You can see the big downturn in spending at the beginning of this thing, and guess what? Final demand, aggregate spending by these three parts of our economy is already back to long-run trend lines. Now, that isn't true for GDP. GDP is still a couple percent behind where it was relative to that long-run trend. So we've seen a bounce back in consumer spending. We have not seen the bounce back in overall production. Why is that? Well, again, it has to do with the odd nature of this particular rebound in the economy. To put it simply, basically, we've had a big surge in spending on goods, and that big surge in spending on goods is creating a situation by which, well, we just can't produce enough in this country, so we're seeing an enormous widening of the trade deficit. That's that gap between those two. Our consumption is back to normal, but we're getting that additional consumption from the rest of the world, which is why production is just lagging. Now, why was this recovery so quick? Why wasn't this a depression-type situation? Well, look, the pre-recession economy. When we went into the Great Recession, the economy wasn't healthy. It had been highly overheated by the subprime lending that had been kind of dominating the economy over the previous few years. It wasn't just that we had a housing problem. The entire economy was a mess because it was overheated. People weren't saving enough. They were spending too much on everything. There were too many cars. There were too many hot tubs. There were too many homes. This time around, we came into the pandemic with an economy that was growing slow but steady, and the fundamentals of our economy, take, for example, savings rate that were at a 30-year high, were actually very good. In other words, this was an economy that could deal with the shock in a much better way than we might have back in 2006. As for the recession driver, back then, the big problems in our economy had to do with the fact that people were overspending, they weren't saving enough because they felt rich. They felt rich because asset markets had gone so high. Now, when everything broke, that asset wealth that they thought they had disappeared. It turns out it was a mirage, and households said, well, I have a balance sheet problem. I have way too much debt. I don't have enough wealth. What do we need to do? We need to save. You save more, you spend less, and what that does is it creates a general problem across the entire economy. Yes, consumer finance and the auto sector and the housing sector got particularly hard hit, but the entire economy felt weak because households were trying to rebuild their wealth. This time around, we didn't have that situation at all. Indeed, this time around it was a supply shock rather than a demand shock. What do I mean by that? Easiest way of thinking about it, in 2010, people didn't go to restaurants because they couldn't afford to. They had to save more. In 2020, they didn't go to restaurants because they weren't allowed to. The reason that's different is they took that money they didn't spend on restaurants and they spent it somewhere else in the economy. If anybody tried to buy a bicycle last Christmas, you know exactly what I'm talking about. People were buying campers and boats and all the things that they decided to buy because they couldn't go to Disneyland, because they couldn't take the second honeymoon to Paris. So, in a very real sense, the hits to some parts of the economy were actually offset by strengths in other parts of the economy. That didn't happen in the Great Recession. Government response back then was inadequate. This time around, government response has been excessive, and the net result of that, last time around, it was about a 9-year cycle all the way around to full recovery. This time around, it was about 1 year, and by the way, the economy is now in the process of overheating. Now, as noted, an uneven recovery. Take a look at the left-hand side. This is consumer spending relative to the long-run trend, and I broke it down into durables, non-durables, and services. As you can see, services about 5% below trend even now, right? Hotels, restaurants, they aren't fully reopened. We don't have conventions going off at the same rate they were a couple of years ago. But that lack of spending on the services side has turned into more and more spending on the goods side, particularly durable goods. At one point in time, durable goods were about 25% above overall long-run trend. And both spending on durables and non-durables today is still about 10% above long-run trend. And what's amazing about that number is people are still buying above trend, even though there's very little to buy. Take a look at the right-hand side. Retail inventory to sales ratios have never been this low. you think of it this way. Even if demand went back to normal tomorrow, we would take years for overall retail part of the U.S. economy to catch up, as the case may be. You could see it in the ports. Imports are way above normal at this particular point in time. Industrial production already back to where it was pre-pandemic, and even then they can't keep up. Indeed, if you just take a look at a satellite overlooking at these ports at the Port of LA and Long Beach, you can see those ships running down, just waiting to get into the ports to drop off stuff. What's going on? Well, it's a combination of really three things. One thing is that it was a very conservative expansion last time around. You know, in the very slow recovery, we moved into kind of a slow growth, normal growth economy. And in the midst of that, we never had the kind of excessive exuberance that often is seen in expansions. In other words, a lot of businesses just didn't overinvest the way they typically do. Home builders didn't build a lot of new homes. Shippers didn't order a lot of new container ships. Auto companies were actually shrinking, if you will, their inventories, trying to get more just in time to save money on the flows. This was an economy that had very little in the way of excess capacity. Last year, of course, we were told it was a depression. A lot of these folks even shrunk their capacity more, and then demand came back at levels we're just not used to seeing. The lack of capacity combined with, of course, more demand than we typically would see has created a big backlog problem. And it feeds back on itself. You think about the fact that we don't have enough boats, and now the boats that we don't have enough of are stuck outside these ports for 2-3 weeks at a time, just making the problem worse. Now, this is one of the reasons why container costs have gone up by a factor of 7, almost $10,000. And of course, yes, the governor, our president, is starting to get involved, trying to get more stuff to come through these ports quicker. But keep in mind, even if you get into the ports, you're still lacking a truck driver to get it to the warehouse, and you're still lacking a warehouse person to get it broken down and sent out to the retail stores. There are problems all the way across the board. And you can see it in the auto industry almost better than anywhere else. Take a look at the left-hand side. This is auto and light truck sales in the U.S. They're down 33% over the course of the last 6 months, which the only time you see that is in the middle of a recession, not an economy that's booming forward. But again, we know this isn't a demand problem. Look at auto inventory to sales ratios. Look how low they are. Now, mind you, we came into the pandemic with those already going down. Again, auto dealers were either anticipating a recession or were just trying to be more efficient, and they've been shrinking their inventories anyway. We got into this, demand spiked, and now everything's getting purchased. And yet again, one more sign of this. If you're wondering what's happening when there's not enough cars to buy, well, everybody needs to buy something, and price of used cars is going through the roof. Your eyes do not deceive you. Price of a used car is up almost 50% from where it was about a year and a half ago. In other words, that story from your brother-in-law about the old truck he sold for what he bought it for might be true, Now, inflation, of course, is really being across the country right now, particularly in the commodity side. You can see 20% increase in commodities driven by energy. Used car trucks are way up at this particular point in time. And yes, you're seeing it fed through to CPI, overall CPI up about 5.5% year over year. Now, the Federal Reserve keeps telling us that this is a function of these supply chain problems. And I kind of agree with that right now. But by the way, there seems to be the inherent, if you will, supposition that because this is driven by supply chains, it won't turn into structural long-run inflation. On that one, I completely disagree, and we'll come back to that in just a couple minutes. Another thing to keep in mind, too, I was called by a reporter the other day, and they said, well, these price increases, CPI, isn't this really bad for American consumers? Isn't this really hurting workers? To which I pointed out, no, you seem to get it backwards. Inflation is being driven by consumer demand. Inflation isn't hurting consumer demand. It's the other way around. Now, mind you, if you aren't one of those people who've seen a big increase in your wealth, maybe you are being hurt by this. But really, overall, the incredible demand for anything in the U.S. right now is exactly what's driving these prices up. Now, as for when things start cooling off, we know part of the supply chain will eventually catch up. Take energy prices, for example. We see West Texas oil prices getting up to about $80 a barrel. You certainly see it at the gas pumps. But let's keep something in mind. In the end, the U.S. is the marginal producer of oil, if you will, in the U.S., in the global economy right now. We haven't seen fracking take off again, but we know, of course, with prices at $8 a barrel, it's going to be worth it, and they're going to be putting more holes in the ground. Expect U.S. production to pick up, and eventually prices will come back down again. But overall inflation, that's another question. Now, we've just been through the Delta surge. There were a lot of worries about this. The good news is the number of new cases is coming down. Did this hurt the economy over the course of the last couple of months? Well, here's the best statistic I can show you. This is data from Las Vegas, as the case may be. You can see on the left-hand side, that's people coming through McCarran Airport. And the right-hand side is gaming revenues coming from the UNLV Center. Apparently, people didn't care that much about Delta Wave because they kept flocking to Vegas and having fun and spending time at the tables, as the case may be. And even here in California, the only thing you can say about this Delta Wave is that overall it slowed down the pace of spending on the sectors that have been hit so hard, like transportation, restaurants, and so on and so forth. So the Delta Wave didn't really mean all that much. And indeed, I expect that after this quarter is done, you're going to see an overall pickup in spending and economic output as well, driven, of course, by excessive degree of policy. What do I mean by that excessive degree of policy? Well, let's take the Congress for a second. $5 trillion in fiscal stimulus, which is an incredible amount of money like we've never seen before. Some made sense, expanding unemployment, who gets it, how long they get it, some local government support. But then things got really weird. For example, the PPP loans. Well, if it went to a restaurant, maybe makes sense. Went to a law firm, not sure why that law firm needed to be subsidized through this particular downturn. And then, of course, you start talking about the direct transfers of people. Yet again, very strange. There's no doubt that some of the folks that got those checks from the federal government needed that money and they were happy to have it. But that was a small portion of those folks. You remember, these checks went out to 110, 120 million families. And overall, most of those families kept their job, they kept their income. Their problem was they couldn't spend money. Remember, they couldn't go to the restaurant, they couldn't go to Disneyland. Giving people money they can't spend is not stimulating the economy. It's not turning into direct spending. What you are, really, more or less, is trying to buy an election. And that's exactly what was going on last year. And it's not just how they were giving it to people, it's how much. You know, on the right-hand side, you can see personal income trends over the last couple of years. For every dollar of lost earnings, Congress gave American households back $3.50. It was a 3.5 to 1 replacement trend. Bizarrely, in 2020, in the midst of the pandemic, disposable income went through the roof because the level of just money handouts was so over the top. And what did people do with it? Again, you can't spend it. They saved it. They paid down their debt. It wasn't just Congress. The Federal Reserve, they did $4 trillion in quantitative easing. They pushed the federal funds rate quickly back down to zero again. Again, seems like a good idea. That's what Ben Bernanke and Janet Yellen did a bunch of years ago. Worked for them, right? Well, let's keep something in mind. They had a real crisis on their hands. In 2008, 2009, the U.S. financial system, the banking system, was pushed to the edge of complete insolvency by the massive amount of loan losses going out there. The stock market had absolutely plummeted. Household wealth was disappearing. They had massive deflationary problems on their hand, and you had to put a ton of money into the economy to offset that. Jerome Powell just did $4 trillion in quantitative easing because, well, I don't know why. I mean, you look at the consumer credit markets, delinquency rates are down, stock market, second highest PE ratio we've ever seen. What crisis is Jerome Powell responding to? It's kind of a mystery. And by the way, that's an important mystery because it's very scary when you start thinking about the consequences of this excessive amount of monetary stimulus. Now, you can see it in the data. Left-hand side, this is cumulative personal savings. The red line, if you will, that lower line is what would have happened but for all this stimulus. The blue line is what's actually happened. About $6.5 trillion of additional personal savings, money people have just put to one side. $3.5 trillion of excess commercial bank deposits. I mean, we feel great, right? This generation has made out like bandits through this massive pouring of public money into the economy. Take the left-hand side. This is the financial obligations ratio, the share of income spent on rent, credit cards, student loan payments. Prior to the pandemic, it was about as low as it's ever been. We all went out and refied our homes at these incredibly low interest rates, and it has dropped 2 percentage points from where we were. Never has a generation of Americans been this unfinancial obligation constrained, if that's a logical sentence to say out loud. It's kind of crazy. And on the right-hand side, this is year-over-year change in the U.S. aggregate household net worth. On a year-over-year basis, household net worth has grown by 23%. Over the last 2 years, that's $28 trillion, because it isn't just the money we were given, it's because the housing market's on fire, the stock market's on fire. Every asset is on fire. So yes, we feel rich, but remember, this is all being generated by $9 trillion of stimulus spending coming from the Federal Reserve and Congress. It's one of the reasons why the housing market's on fire. Prices are up, sales are up, existing home sales are up. The market's absolutely taking off. Look at these prices, 20% increase in prices year over year. Phoenix, San Diego, Seattle, top of the list in terms of increases in prices. Remember, a year and a half ago, it was 30% of homeowners are going to stop paying their mortgage. Right now, it's like we haven't seen a hotter stock market ever. Now, housing market ever. It is cooling off just a little bit. Residential permits are cooling off a bit. Inventories of new homes are coming up. But the inventories of existing homes is still very, very low. What this says is there's a lot of people trying to get into the market still, trying to get that first house, as the case may be. It's the entry level where you're seeing a lot of compression. Top end of the market's cooling off just a little bit. Now, why did it take off? Well, a couple things here to keep in mind. First of all, housing was in good shape in the first place. I know 2 years ago we were told housing was a mess. It wasn't. Home ownership rates were indeed coming back up, but the market had paused briefly because mortgage rates had got up to close to 5%. So a lot of folks took a step back. And you know, housing has a big feedback effect. If no one's buying a home, you're not in much of a rush to buy a home. You'll take your time. Maybe your prices will go down. Maybe you'll find that perfect house you were always dreaming. And so a cooler market driven by higher interest rates created a very cool market because of the feedback. Now, you pop forward in time, suddenly the Federal Reserve's pouring money in, they're buying all sorts of Fannie and Freddie bonds, and the net result of that is interest rates absolutely plummet. What a great time to buy. Everybody rushed out there, and here's the key, there wasn't a lot of inventory. So everybody went from taking their time to, wow, I'll never be able to buy a home. And yeah, those stories of 40 or 50 people bidding on one home, those are kind of true. Prices, of course, are going through the roof. Now, is it a bubble? Not yet. Maybe it will be, but not yet. Look, over the last 10 years, mortgage lending has been very constrained, 4% increase in outstanding net debt per year, less than price growth, which means equity levels have been growing. The quality of these loans have never been better. Over the last 10 years, 75, 80% of all this new mortgage debt, over FICO scores over 720, and perhaps even more importantly, take a look at the right-hand side. You can see the data on owner costs. And important, take a look at California. The bottom set there, this is the share of homeowner housing cost constrained owners. That is to say, households that are spending over a third of their income on supporting that house. In 2011, 40%, almost 40% of Californians were spending that amount of money on their home. That's a high number. These folks are really close to financial problems because you can't take a month off because of a health injury when you're using that much of your income on supporting your home. Well, despite all the enormous increase in home prices in California, that number fell from 38.6% to 28.5% from 2011 to 2019. We are constantly being told California has an affordability crisis. Not really, at least not from the point of view of the people who are buying these expensive homes. They can afford them. As for everybody else, there's simply nothing for them to buy. Remember, when there's a very limited supply of homes, only, of course, the high-income households will have an opportunity to buy that property, and that's what drives those prices up. We have a supply problem, as simple as that. As for apartments, nice and steady. Again, vacancy rates, particularly some of those hard-hit markets like rental rates, asking rental rates have been coming up in even hard-hit places like San Francisco. We keep being told millions of people are going to be evicted. We just did some work on this for the California Apartment Association, and really most of this is just nonsensical. It didn't make a lot of sense. And indeed, you know, both the state and the nation wonders why these funds they set up to pay back rent haven't been utilized. But you know, a couple things to keep in mind. If you look at renters coming into the pandemic, actually, financially speaking, the healthiest they've been in 10, 20 years. Even in California, the median rent as a percent of household income has been falling. And because of all the support they've been given, particularly low-income households, their spending has come back. There isn't any sign of any kind of major financial crisis among renters any more than there is among owners. This was never, of course, a real story, but this is the world we live in. Somebody said it could be a problem. It felt good to talk about this problem, and it became, if you will, conventional wisdom, despite the fact that there is no evidence to support anything like this. Now, I've told you lots of good news about the economy. There's $28 trillion in new wealth. Consumer spending has got up. Housing market's doing great. Where are the jobs? That's the paradox. Because every time you pick up the paper, what they want to talk about is, wow, there's 6 million fewer jobs in the U.S. today than there were pre-pandemic. Clearly, we must have a problem. Well, yes and no. Look, Yes, we have 6 million fewer jobs than we did a couple of years ago, but the number of jobs in our economy is in equilibrium. You know, I appreciate that in 2011 there were fewer jobs in the U.S. than there were in 2006, and that was because of a lack of labor demand. But that isn't the only thing that could drive that number down. There could also be a problem with labor supply. Take a look at the right-hand side. In September, the U.S. unemployment rate was 4.8%. That doesn't sound like a labor market that's having a problem with labor demand. And indeed, you look at the data from the JOLT, job openings and labor turnover, 11 million job openings in the U.S. economy right now, quits at a record high rate. Clearly, this is not a market that's suffering from a lack of labor demand. This is a labor supply problem. Why a labor supply problem? On the right-hand side, the U.S. labor force is 3 million lower than it was pre-pandemic. Why? Well, again, we've had this conversation, some of our past. We talked about the looming labor shortage. On the left-hand side, this is growth in the U.S. in working-age population, and it's been slowing for about 20 years. And indeed, before the pandemic, the number of people in their prime working years was actually negative, was shrinking in the U.S. This is because boomers are starting to retire. Boomers are that big demographic inflection point in the U.S., all coming out of families of 10 kids. They all had one kid, and as a result of that, our population pyramid has turned into a population column. We don't have enough people. Now, we get into the pandemic, and what happened? A bunch of people said, hey, what a great time to retire. Now, we hadn't felt the labor crisis, but you can see on the right-hand side, you can see how as labor markets got tighter and tighter in 16 and 17, how participation rates started to drift up. This is kind of a natural effect. Hey, I can't replace you. You got to stay here. I'll pay you more money, and people stuck around. But the pandemic hit, and a lot of those folks who've been hanging around said, okay, this is the time to go ahead and finally retire, and the participation rate dropped back down to the trend it would have been on, but for those incredibly tight labor markets. Now, we have very tight labor markets right now. Will some of those people come back? Maybe. But in the meantime, we have a big problem. We just don't have enough people. Look at the right-hand side. This is the unemployed to job openings rate in the U.S., and you can see we were right back to where we were in 2019. And a lot of folks, particularly on the right, have made this comment, though, well, we think it's unemployment. Unemployment is making people not want to work. But I like to say, look, workers have opportunities, and they know that, right? They're not going to just take any job. They're not going to slop dishes if they can go out and get a job that gives them good pay, gives them some benefits, gives them a career path, gives them some training. In other words, there's a big difference between I don't want to work versus I don't want to work here. And what you're seeing in our economy today is really more of a function of I don't want to work here. People have choices, and of course, they're going to go ahead out there and take it. And we kept hearing about how this has been so bad for low-skilled people. But you know, there is no K in this recovery, if you will. Indeed, what's amazing is you don't see any earnings hit. It doesn't look at all like a recession. You can see the data on the left-hand side. This is earnings growth by education. You see the big hit during the Great Recession. During the pandemic recession, no hit to earnings at all. Take a look at the middle side. Turns out right now in the U.S., the greatest increase in earnings growth is for people at the bottom quartile. The lowest income workers in our economy right now are seeing the greatest increases in pay. And that's true for part-time versus full-time folks as well. In other words, if you're worried about inequality, I have a solution for you. Labor shortages are going to fix a lot of these problems. But if you're a business, it's going to be tough, and that's particularly true if you're a business in California. Look, California is behind the rest of the United States in terms of coming up with, if you will, getting back to where we were pre-pandemic in terms of jobs. We haven't bounced back as much, but we have the same problem. The California unemployed to job openings is basically back where it was in 2019. We have exactly the same problem. We don't have enough workers. And if you take a look at the data, you can see some sectors are down, but if you're leisure and hospitality, you know, you were closed for a year, you're trying to get back to work, and there's just no one to hire out there. Well, this, of course, is a function of housing and housing supply. On the left-hand side, Gavin Newsom came in, said he was going to break the housing logjam, get those 3 million units built. Nothing has absolutely happened, and as a result of that, labor force growth in California, which used to grow much faster in the United States, is growing much slower than the rest of the United States. People are simply moving away. It's not high-income families fleeing regulations and taxes. It's low-income families looking for a place to work. And what does that mean for local labor markets? Well, you can see it on the right-hand side. This is some data from one of the Federal Reserves. And as you can see, earnings growth, as strong as it is for the U.S. overall, is even stronger here in California. Again, great for workers, but tough on businesses where we are right now. And don't feel too bad for California. Remember, lower skilled workers are moving out of the state, and with them, they're taking some of those lower skilled jobs and some of those lower skilled industries. Overall, the state's still doing great. You can see on the left-hand side, you go back 20 years, we haven't seen near the labor force growth of Nevada or Arizona, but you look at output growth, actually, we're seeing much more output growth in California compared to our neighboring states. We're doing okay in California, in as much as we continue to have high-income earners doing high-income jobs, and this economy continues to boom around them. But sectors of the economy that can't, if you will, afford to pay these rents are simply having to move out of state, just like the workers that typically move in those industries. So, Country Club California, as the case may be. Now, business investments coming back, business profits are back, commercial markets are doing just fine. You can see on the left-hand side, there's been no surge in commercial real estate delinquencies, just like the mortgage markets are clean. In terms of lending, overall, banks are willing to lend. They say, well, there's not really any problems out there. Now, overall, spending, if you will, non-residential construction put in place has been nice and steady, but permits here in California are down right now, in part because there's a lot of uncertainty. Now, a lot of the uncertainty has to do, of course, with really, again, the acceleration of underlying trends that were already in place in our economy. Take, for example, on the left-hand side, this is real investment in structures over the past 10, 12 years in the U.S. And you can see a few years ago, spending on retail started to go down. After all, retail is getting replaced by online sales. And the other side of that, you can see warehouses going up, up, up. They have been the golden child. The real interesting thing, of course, has been office space. Because on the right-hand side, office space, you can see never saw any kind of real big declines in vacancy rates since the Great Recession. Indeed, office vacancy in the U.S. have stayed above 16% pretty consistently. Now, why do we see so much more office construction? Well, from my perspective, it has a lot to do with, if you will, labor shortages. If you're in an economic hot zone like San Francisco or downtown New York, if you want to have the best workers, you got to have the nicest office space. And you saw a lot of new office spaces opening up in these downtown regions, but they were emptying out the suburban stuff. Now, we came into this pandemic, and interestingly enough, retail did okay, but office is seeing a big increase in overall vacancy rates. What's going on? Well, in terms of retail, don't get too excited. Look, retail, a lot of spending went online. Grandma learned how to buy toilet paper from Jeff Bezos, and she's not going to forget that. She likes it. But retail has been balanced, of course, by the fact that this excessive surge in overall retail sales is helping the brick and mortar stores as well. But at some point in time, things are going to get back to normal, and yet again, we're going to see de-retailing. I have a simple solution for this state. I keep telling the governor what you should do is, as opposed to doing all this nickel and dime stuff, auxiliary units, how about just rezone all retail land in the state, mixed use, retail, residential. Kill two birds with one stone. Sadly, that hasn't happened yet, but out there we still have to deal with too much retail space. As for office itself, well, yet again, a lot of the uncertainty has to do with this trend, the work from home trend. You know, this is the data from the Atlanta Fed. According to a survey of CEOs, about 10% of office days will work from home before this, about 30% will work from home after this. That's a lot of days being worked from home. And by the way, it doesn't mean some businesses are going to be all work from home and some all from the office. Indeed, there's a survey of folks done out there. About a third of folks said, I never want to work in the office, and about a third of folks said, I never want to work at home. And it's not industry by industry. What this boils down to is really about lifestyle. If you're a young single worker, you want to be at the office because that's a center part of your day, getting you out of your house. If you have kids who are 11 years old, you want to work at home because it makes managing your kid's life that much simpler. So every business, because of labor shortages, is going to have to figure out what's what and do so accordingly. Now, what that means is going to be more concentration of jobs in these dense urban centers, and Patrick's going to come and talk a little bit about that. But at the same time, there's going to be a greater diversification of where people live. You might live very close to the office, and you're going in every day. You're suburban, you're going in twice a week, or you're living out in the wilderness, and you're flying into your office a couple times a month. A lot of different choices, and yeah, employers are going to have to do it. Now, with all that in mind, where is the downside? Well, it really boils down to, again, that risk on the public sector side. And let's start with a conversation about inflation. Jerome Powell keeps telling us over and over he doesn't think inflation's a risk. I don't know how he can say that. Look, two things cause inflation: excessive demand and excessive amount of money. Right now, we have both. Take a look at this graph here. This is the long-run graph, and its inflation is that bottom line. The top line is what we call unit money supply, M2 divided by GDP. And if you go back to the 1970s when we had that inflation, what do you see? A lot of money, and then when you had surges in nominal demand from the Vietnam War or one of those oil shocks, bam, it turned very quickly into inflation. Now, Volcker came in the late 70s, fought inflation, caused at that point in time a fairly sharp downturn in the economy in the early 80s, but he conquered it when money supply came down for years and years, turned around, hit bottom somewhere in the late 90s, and started coming back up again. By the way, take a look through the Great Recession. See how there's no change in the unit money supply? Because Ben Bernanke and Janet Yellen took just enough money into the economy to offset deflationary effects. They did what they were supposed to be doing. Jerome Powell comes in for no particular reason, decides to do exactly what they did, and lo and behold, this time the money supply has absolutely exploded. We have more money in the economy today than we did in the 1970s, and yes, incredible amounts of aggregate demand driven by that $28 trillion in wealth. To say that this is not potentially inflation causing is something between either ignorance or complete gaslighting. And it doesn't make me very comfortable about this economy. And yes, of course, there's the federal government as well. The federal government has picked up trillions of dollars in debt, almost $10 trillion in debt over the last 7 years, $5 trillion in the last 2 years. And over the last 20 years, think about this. In 2000, federal debt to GDP ratios were about 58%. Today, it's 130%. We've over doubled our debt to GDP ratio. Now, this is where it gets scary. Right now, the bond markets haven't fully reacted to, of course, what's happening in inflation. And that's because the bond markets are not proactive, they're reactive. They just listen to what the Federal Reserve says, and he says inflation is a risk, and so they dutifully going out buying bonds as if there is no risk. But at some point in time, enough inflation will cause them to recognize that they have to start pricing it in, and interest rates will go up. When that happens, the Federal Reserve has to respond, and they have to, in turn, raise interest rates. Now, all those increases in interest rates are going to be tough for you and me, particularly if you have to refi our house. But think about the federal government. They've been able to get away with doubling the debt to GDP ratio because of the decline in interest rates. Federal interest payments as a percent of GDP has been flat over the last 20 years, despite the enormous increase in outstanding debt. It's easy to see how this shakes out. Big increase in interest rates turns into a huge increase in federal interest payments, which in turn starts shoving out other types of federal spending. And that, of course, leads to both a monetary and negative fiscal shock at the same time. And yeah, that can be very ugly for the economy. Now, how does it all shake out? What's the big picture? Well, look, the economy is back, but from a consumption standpoint, we're already fully recovered, and the V was the only logical outcome. We would have an economy that was even farther ahead if it wasn't for the fact that lack of supply is keeping output held back just a little bit. You know, I said unemployment by below 5% by the end of the year. Actually, as of September, is already 4.8%. This economy is on fire, and it's going to be there for a while, but at some point out there, there has to be a sugar crash. How bad will it be? It all depends on how long it goes. You know, the more the private sector, if you will, gets overwrought, shall we say, trying to keep up with everything that's going on, well, that means when the sugar crash does come, it'll be that much more painful. If the Federal Reserve turned around tomorrow and started tightening, it makes that risk that much less. But I don't think they will. That isn't the conversation happening in D.C. right now. As for labor markets, look, in the end, the slow recovery in jobs is a function of labor supply. If you're worried about inequality, this is great news. If you're trying to run a business, this is bad news. And by the way, it isn't changing. It's going to be here for a while. Last but not least, I'll wrap up with some policy thoughts. First of all, policymakers, time to turn crisis mode off. The crisis is done. They don't want to let go. After all, every politician knows a crisis is a reputation-making situation. You got to take it for all it's worth. Unfortunately, they're taking this to the detriment of the health of the long run of the U.S. economy. We desperately need immigration policy to fix our labor shortages. And in the meantime, we need programs to encourage both senior and female employment. As for female employment, that's pretty clear. The only thing you have to look is at the pre-K funding they're trying to put into this next budget package. By the way, of all the things they have in there, it probably has the best NPV for this economy because, you know, look at Europe figured this out years ago. If you want to expand your labor force when you don't have expanding labor population, you need women to be able to work, and that means giving them the support they need to allow them to go out and have a career. We need to do this. As for Sacramento, yet again, please take the crisis hat off. When you're thinking about the state, remember that what's good for San Francisco isn't necessarily what's good for the Inland Empire, and ultimately economic development for the next decade is simply boils down to one thing: attracting the workforce of tomorrow. Workforce attraction will allow your economy to grow. And by the way, here in the Inland Empire, here in the state of California, that means one thing: housing. So that's the big picture. And with that, I'm going to go ahead and turn it over to Tanner, who will give you the local situation. Thank you very much.
Thank you, Chris. Well, that is certainly a more optimistic outlook than many of us might have expected. Although there are clearly complex long-term challenges and instabilities in our collective future, it's nice to hear that for the next couple of years, it looks relatively bright for the U.S. and California economies. Now I'd like to introduce our next speaker, who will bring things a little closer to home and deliver an economic outlook for the Inland Empire. Dr. Tanner Osmond is the Manager of Regional and Sub-Regional Analysis at the Center for Economic Forecasting and Development. Dr. Osmond is also an instructor in the Department of Urban Planning at the University of California, Los Angeles. His research focuses on how local economic development and land use policies affect the performance of industries and regional economics. Dr. Osmond co-authored the book, The Rise and Fall of Urban Economies, a comparative study of the Bay Area and Los Angeles economies, published by Stanford University Press. Please welcome Dr. Tanner Osmond.
Thank you very much. It's a pleasure to be here today, and thank you to everybody who is here in attendance. I'll be focusing on the Inland Empire, and my talk is going to be divided into 6 primary parts. Very briefly, I'm going to provide an update on COVID-19 in the region, and overall, the trends have been very encouraging. I'm going to then move in to dive down into the region's economy. I'm going to first be talking about the region's labor market. Over a long-term perspective, the region's economy has been a land of opportunity. It's absorbed a lot of workers and provided a lot of jobs for people in the region. Another feature of the region's labor market is its resiliency during the pandemic. It's performed much better than other parts of the state's economy. We're then going to talk about output and consumption in the region. And again, over an extended period of time, we see that the region has been a growth machine with GDP growth that has been unparalleled in the state. We're then going to move on to talking about real estate, both residential and commercial. When I was trying to come up with a phrase which could best summarize what's been happening in the residential real estate market, the best word that I could come up with was wow. It has been quite a breathless move in the local residential real estate market over the past 18 months or so. With respect to the commercial real estate market, things are a little bit trickier. There have been some definite headwinds in certain subsectors of commercial real estate. The big question is going to be the extent to which these headwinds represent a permanent shock or a minor bump in the road. I'm going to finally end the discussion with some very brief remarks about what the future might look like in the region. First, I'm going to provide a brief update on the COVID-19 situation in the region, and overall the news is incredibly positive. While there was a spike in cases in the early summer, we didn't come close to approaching the mass number of cases that we saw at the beginning of the year, and a big reason for this is vaccination. Whether we look across the state, in Riverside County or San Bernardino County, we see now that the majority of people are vaccinated, and that is going to be one of our best weapons when it comes to controlling the spread of the virus in the future. With respect to labour markets, I'm going to first start talking about the big picture. If we look over the last sort of 10 or 15 years, we see that the region has seen extraordinary employment growth. So if you were to look at the chart on the right, you can see that 380,000 jobs were added to the regional economy over the last 10 years alone. To place that number in perspective, there's only 4 cities in the state of California that have more jobs than were added to the Inland Empire economy over the past 10 years. Now, if we look at where some of that growth is occurring, it's still extraordinary to me, the sheer growth of the logistics sector in the region over the past 10 years. 160,000 jobs were added in the Inland Empire in the logistics sector alone, which accounts for around about 42% of all jobs added to the region's economy. I always have to double take when I look at the statistic, but if you look at the contribution of logistics job to the region's economy, today they count for around about 28%, or basically 1 in every 4 jobs in the Inland Empire can be attributed directly to the logistics sector of the economy. But overall, what we see over the past 10 years is great employment growth. Not only have we seen great employment growth, but the region has also done a great job of absorbing workers. So if you look at the chart on the left, you can see that the labour force in the Inland Empire has far outgrown the labour force growth in California and many of the peers for the Inland Empire in Southern California. And again, the chart on the right is showing you that not only is the region absorbing labour, but it's providing jobs for labour as well. So not only do we see more workers moving to the region, but the job growth in the region has far exceeded the job growth that we see at both a statewide level and compared to some of the peers, Inland Empire's peers in Southern California. Against this backdrop of strong job growth, there's been a consistent narrative with respect to the Inland Empire, with respect to wages. And we have seen real wages in the region grow over the past 10 years, but the Inland Empire does still lag both the state and, again, some of its peers in Southern California. And if we were to sort of dig a little bit deeper into why that is the case, why is it that the wages in the Inland Empire are lagging other parts of the state, I think the chart on the right does a pretty good job of summarizing this. What the chart shows is that if we look at workers who hold less than a college degree, so people who either have high school diplomas, have less than high school education or some college, the wages of those workers in Inland Empire are comparable to the wages earned by equivalent workers in the rest of the state of California. The big difference we see is with respect to people who hold a college degree or a graduate or professional degree. Here we see that the wages paid in California are around about 20 to 23% higher than the wages which are paid to equivalent workers in the Inland Empire. I think this represents an opportunity for the region as we look out into the future, and I'll return to this point later. Now, if we were to look at the labour market over the last 18 months, one of the things to note is that heading into the pandemic, the Inland Empire was adding jobs at a far faster clip than many other parts of the state. So in that period from February 19 to February 2020, the Inland Empire added jobs at a rate of 4.1%, which was effectively more than double the number of jobs which were added in the state over that period. What we also see in the chart on the left is the recovery of the respective labour markets listed here since the pre-pandemic peak. So if we measure job growth from February 2020 to September 2021, the Inland Empire has weathered some of the storm clouds a lot better than other parts of the state. The chart on the right gives us a pretty good indication for why this is the case. If we were to look across all of the sectors in the region's economy, many of them still employ fewer people than was the case prior to the pandemic. But we've seen great growth in the logistics sector, where during this period over the last 18 months, 29,000 jobs have been added to the region's economy in the logistics sector, a growth of 7%. And that sort of is one of the reasons for the region's respective resiliency. That, and of course, the region's economy doesn't rely to the same extent as some of the coastal regions on tourism in particular. There's a lot of talk about the unemployment rate, and thankfully we're heading and trending in the right direction. But what is mentioned much less frequently is what has been happening with wages over the past 18 months. And we see in the Inland Empire, wages have increased by 5%. So this is due to a number of the reasons that we mentioned earlier in the presentation. The labour shortage in the face of strong demand for job growth is placing upward pressure on wages. So one of the most positive aspects of the labour market over the past 18 months has been this increase in wages, which is really continuing a trend which began 4 or 5 years prior to the pandemic. With respect to GDP, the Inland Empire's GDP on a relative basis has far outgrown GDP in places like Los Angeles, San Francisco, even in the state of California. In fact, since the year 2000, GDP has increased by around about 1.5 times, which is extraordinary growth. On the right chart shows GDP per capita, which is where the region has fared slightly less well. And again, this comes back to the point that I was making earlier and the point that I'll come back to later in the presentation, which is that the jobs being created in the region aren't paying quite the wages that are being paid in other parts of the state. Despite some of the gloomy headlines at the outset of the pandemic with respect to the impact that the pandemic would have on the economy, we saw in 2020 that taxable sales in the Inland Empire was greater than in the year prior, in 2019. And to the sort of point that we made in the first part of the presentation, this speaks to the strength of the consumer over this period. That again, despite a lot of the headlines we were seeing, taxable sales within the region actually increased, and in 2021 is on pace to outperform 2020 with respect to taxable sales as well. And an interesting point, which you can see in the chart on the right, is that the Inland Empire's taxable sales far outgrew taxable sales in California over this period. Taxable sales actually grew at a rate which is around about 50% quicker than in the rest of the state of California. Okay. Residential real estate has been on fire over the past 18 months, and there's a couple of ways to dissect this. The first is with respect to home sales growth. While we saw home sales drop in the first part of 2020, the sales growth which has occurred since this time has more than offset the lost sales that would have occurred at the beginning of 2020. And in fact, we've now exceeded the pre-pandemic trend with respect to home sales. Home prices have been on an extraordinary tear over the past 18 months for some of the reasons that were mentioned by Chris at the beginning. We've seen healthy consumers by and large, low interest rates and relatively low inventories, and all this has created a cocktail in which home prices have jumped greatly over the past 18 months. In San Bernardino County, home prices have increased by around 27%. In Riverside County, the number is a little bit closer to 25%. I would just say, though, that home prices in the region are starting to become quite expensive relative to the rest of the nation. So when we compare the Inland Empire's house prices to some of the coastal communities in the region, they look cheap. But when we look at home prices in the Inland Empire with respect to the national economy, home prices are around about 50% higher than are found in the rest of the nation. And as I mentioned, a big part of the push in home prices has been the lack of supply. So if we were to look at housing inventory, the monthly supply of housing in the region is down at historic lows. Typically, we would think of a healthy housing market as one in which there's 6 months of supply. And although we've seen a slight increase off of the lows, there's still around about 2.5 months of supply in the region. And the time that a home is spending on the market, again, is at historical lows. These properties are being sold as quickly as they are hitting the market. One interesting feature of the residential real estate market in the region concerns permits. I showed you some slides at the beginning of the presentation which showed the increase in the labour force over the past 20 years and the extent to which the labour force in the region was really outgrowing labour force rates in the rest of the state and in other parts of the coastal communities of Southern California. But what we have seen over the last 4 or 5 years is residential permits in the Inland Empire start to level off quite a bit. And so what we would want to see in the future, if the Inland Empire is going to continue its role as this opportunity machine, which is able to absorb workers, we would like to see residential permits pick up a little bit more than they have been over the past few years. And I think the big area in which the Inland Empire has been lagging some of the communities in the rest of the Southern California is with respect to multifamily permits. Here we see places like San Diego and LA counties producing way more multifamily permits than is the case in the Inland Empire. And to put this figure in context, the chart on the left shows you single family permitting in the Inland Empire compared to California over the past 10 years. We're forever hearing about the supply problems at the statewide level, and the solution to this problem is for us to build more housing. But it's interesting to note that over the past 10 years, a number of single family permits issued both in California and in the Inland Empire have been somewhat constant. And the same is true for multifamily permits. We see that the Inland Empire has been somewhat on track with what has been happening with California over the past 10 years. And again, to reiterate, if the Inland Empire is going to continue absorbing new residents, we really need to see a pickup in permits as we head out over the next 5 or 10 years. Commercial real estate is a little bit trickier to dissect than the residential real estate market. One of the interesting questions as we look out over the next few years is going to be what is going to happen to demand for office space. There's been a lot of talk in the media about the virtual office and how this could transform cities and where workers live throughout the country. There's a couple of things to note here. First, with respect to the office market, we have seen some headwinds over the past 18 months. We have seen vacancy rates start to tick up, not just here in California and in the Empire, but also across the United States. And one of the interesting questions surrounding the demand for office space centers around work from home trends. So in this chart on the left here, the Census Bureau has tracked the share of people working from home by different occupations in the US economy. And one thing to note is that since the beginning of the pandemic, the number of people who report working from home has actually been steadily declining. But what we have seen is that those occupations which are most likely to be working in offices, that's management, business, financial operations, and professional services, we still see a relatively high share of the people working in these occupations, around about 25%, who report working from home. So what does that mean for the demand for office as we look out over the next couple of years or beyond? This chart on the right is survey data which is produced by economists at Stanford University. And in this survey, they asked both workers and employees what is their preference with respect to work from home arrangements. So they asked workers, ideally, how many days of the week would you like to work from home? And workers report that they would, on average, like to work from home 2.5 days a week. Employers see things slightly differently. Employers report that they would, in an ideal scenario, see their employees working from home just 1 day a week. So whether we look at this from the employers or the employees' perspective, there seems to be an expectation that people will be returning to the office in some capacity over the coming months. So stories of the virtual office or the death of the office do seem to be overshot presently, but what it might mean is that as we look out into the future, how we use office space might begin to change. With respect to retail, there's not a great trend change in the data over the past 18 months with respect to longer term trends. The cost of rents in retail spaces have been somewhat constant, and we've seen a very minor uptick in vacancy rates. And all of this, there are two things to note here. I think one, the secular long-term trends are still in place. We're still moving to a world in which more online consumption is going to occur, and this is going to create a headwind for the retail for retail space. Another feature is, or one of the reasons for the resiliency of retail over the last 18 months is the fact, goes back to the taxable sales slide. Consumers have had a lot more money in their pocket and they haven't been spending all that money online. So demand for sort of in-person retail has been pretty robust given the sort of relative affluence of consumers over the past 18 months. But I don't think any of this is going to change the long-term trend, which is one in which we will see a greater transition to online consumption. With respect to warehouse and distribution, we see an entirely different picture over the past 18 months. In the Inland Empire and across the US, we've seen rents increasing. We've also seen vacancies dropping in a pronounced way over the past 18 months. And of course, this has to do with a lot of the sort of pandemic trends. A lot more online consumption, or the increase in online consumption has meant a greater demand for warehouse and distribution facilities, which has really put pressure, upward pressure on rents and pushed vacancies lower. And we expect that this trend will continue again as we look out into the future. The secular trends are real, and the demand for warehouse and distribution facilities is not going away anytime soon. I'm going to turn now to some of the opportunities and challenges with which the Inland Empire is going to be faced over the next 10 years. And I think there's two ways that we can dissect economic growth. One of the aspects of growth is a quantitative dimension, and another dimension is a more qualitative perspective. If we look at the chart on the left, the Inland Empire has been great quantitatively over the last 20 years. As I mentioned at the beginning of the presentation, it has both absorbed a lot of people and created a lot of jobs. So from a quantitative standpoint, the region has done great. The next step in the region's evolution is going to be more of a sort of a qualitative shift. And if we look at the chart on the right, we look at the share of college degree holders in the Inland Empire compared to the state of California. And this is an area where the Inland Empire still lags. And what is the reason for this difference in the number of college degree holders in the Inland Empire compared to California? Well, one of the reasons for this is that, to go back to a chart that I used earlier on, there are not a lot of high-paying jobs in the Inland Empire for college degree holders with respect to how these college degree holders are paid in the rest of the state. The chart on the right shows the workers in the Inland Empire that commute to other regions. So the chart on the right tracks people who commute out of the Inland Empire for work. And there's a perception that the Inland Empire was a bedroom community, that people who had jobs in LA and Orange counties and San Diego counties who had low-paying jobs, couldn't afford to live in these coastal communities, so moved to the Inland Empire where housing was cheaper. But if you actually look at the data, what we see is that the largest share of workers commuting out of the region for work were actually people who hold bachelor's degrees and grad degrees. Around about 25% of bachelor and graduate degree holders in the Inland Empire commute out of the region for work. And what is the reason for that? The reason for this is that within the Inland Empire, there's not enough jobs to satisfy, a better term would be, there's not enough supply of jobs for college degree holders in the region. And as we look out to the next 10 years, we would like to start to see a shift whereby the Inland Empire is creating better paying jobs so that there's less need for people with college degrees, with graduate degrees to leave the region to commute to the coastal communities. Okay, I'm going to finish my presentation by talking about the short-term outlook as well as the big picture. So with respect to the jobs recovery, we'd expect the region's economy to replace all of the jobs that were lost during the pandemic in 2020. There's still a deficit of around about 50,000 jobs. And like I said, in 2020, we would expect the region to be out of that jobs deficit that was created. We'll also expect unemployment levels to near their pre-recession levels as well. In the short term, I think we can expect to see upward pressure on wages. Again, this comes back to the conversation about labour supply and the fact that there are more jobs than there are people to fill these jobs at the present time. Consumers are as healthy as they've ever been and will continue spending in the region over the short term as well. We would expect house prices to soften. I think that it's unrealistic to think that house prices will continue to grow at 25% a year as we start to see mortgage rates tick up a little. That is going to lead to a softening in house price growth. That doesn't mean that house prices are going to shrink. That doesn't mean that house prices are going to collapse. The fundamentals remain strong. We were just on a unsustainable trajectory with respect to house price growth. And if we go back to one of the slides we looked at the beginning of the presentation, 28% of the jobs in the Inland Empire are found in the logistics sector of the economy. The secular trends in place means that this, or at least the number of people employed in the logistics sector, is only going to increase as we look out into the future, and this is going to maintain a strong demand for warehousing in the region. With respect to the big picture, the Inland Empire for 20 years now has been a growth machine, it's been an opportunity machine. This has absorbed a lot of people and it's grown a lot of jobs. And the region is a veritable economic development success story. But as with every economic development story, there are going to be different phases to development. And some of the advantages that the Inland Empire has held over the past 20 years will start to diminish slightly as we look out into the future. So if we were to think about price, or the region's price advantage, for example, when I showed you those house prices in Riverside County and San Bernardino County, they look cheap relative to the rest of California. But relative to the rest of the nation, the region is starting to become somewhat expensive. These price increases are also going to translate into the commercial real estate market as well. And ultimately, as we look out into the future over the next sort of 10, 20 years, the economy will have to transition to one which is providing higher paying jobs. The true key to sustainable economic growth is going to be the ability for the region's economy to move beyond one which has been a quantitative success to one which is able to focus on more qualitative aspects of economic growth as well. And with that, thank you very much for your attention.
Thank you, Tanner. Well, like the nation and state, it sounds like the Inland Empire is looking fairly strong in the near term. Although we're not there yet, the statistics we've heard certainly show a lot of resilience in our region. Now, our final speaker is going to drill down into a topic that's been receiving a lot of attention lately, the idea that downtowns may be a thing of the past. Given communications technology and pandemic-driven work-from-home trends, there's quite a bit of debate surrounding this idea, and the arguments on both sides can be compelling. To shed some light, I'd like to introduce Dr. Patrick Alder, Manager of Sustainable Growth and Development at the Center for Economic Forecasting. Dr. Alder provides guidance on the Center's core projects surrounding workforce development and economic development strategy. His work includes developing a growth action plan for the City of Industry's manufacturing sector and an economic development and revitalization study for the City of San Bernardino. Dr. Alder has published highly cited work on why large corporations locate where they do, and has conducted economic development engagements with municipalities and planning agencies in both the United States and Canada. Please welcome Dr. Patrick Alder.
My job today is going to be to talk through the community level of transitioning out of this crisis. And communities across the United States are talking about building back better right now. And as we heard from Tanner, in the case of the Inland Empire, building back better isn't so much about building back, because by the end of this year, we're going to be almost recovered in terms of the employment level in the Inland Empire, as much as it will be building back better, getting some qualitative changes going in the economy of the Inland Empire. They're going to make for a better, more transformational growth machine going forward. And what I want to really focus on today is a placemaking aspect to this post-crisis transition. What can be done with this very strong, dynamic economy that already exists in the Inland Empire to ensure that that economy can be the right character and tenor going forward? And I'm going to do this actually by talking a little bit about sports at the outset. The Inland Empire is a very interesting major metropolitan area in the United States in that, as you can see, it is about as big as a lot of other major league metropolitan areas. Metropolitan areas like Boston and San Francisco and Detroit, which have each 4 major league sports teams. It's bigger than metropolitan areas like Seattle, Denver, and Baltimore, which also have 3, 4, 2 major league sports teams. And it's quite interesting. There you have in the middle, Inland Empire, 0 major league sports teams. If you're a sports fan or anyone who's an ally of the Inland Empire and aspires for this region to join the rest of the leading regions in the United States, you might wonder why this is the case. And surely, if you ask 5 economists, they might give you 5 different answers. Here's the one that I'd really like to focus on. There's no place to put a major league sports team. Now, what do I mean by this? I mean, first off, there's no physical stadium, obviously, to put a major league sports team. This is the closest thing we have in San Bernardino, the AAA baseball stadium, to a major league stadium. It seats 9,000. It would need to seat 3-4 times that amount of people in order to accommodate a major league team. So obviously there needs to be a stadium to support, infrastructure to support a major league team. But I'm not just talking about infrastructure. I'm talking about the surroundings of the AAA team in San Bernardino, or the surroundings of any other of the region's AAA or AA baseball teams. If you look at those areas, you see that there's nothing like the sort of environment, the sort of dynamic urban environment that you would find in and around major league downtown stadia. And when you look at this from the air, this really comes into focus. There's a lot of underused and blank space in this area right around the San Bernardino Stadium. And of course, this is not to diminish the thrills of a AAA baseball stadium or the minor league baseball in general. What this is to say is that San Bernardino is a turbocharged economy, and generally speaking in the United States, with turbocharged economies, you get major league amenities, major league infrastructures. When you look at a place like Milwaukee, Greater Milwaukee, and Greater Milwaukee being the site of 2 major league sports teams, you find, on one hand, a much smaller region, a significantly smaller region. Once again, Inland Empire is the 13th largest metropolitan area in the United States. Greater Milwaukee is the 39th largest. But at the same time, you find the sort of dense urban environment, or at least denser urban environment, that can accommodate a major league team, and not just a major league team, but a team that can host major downtown gatherings every time the local basketball team plays a playoff basketball game. So they have this thing, downtown Milwaukee, you might have seen it if you were watching NBA basketball this past summer, called the Deer District. Every single day there's a basketball game, whether home or away. People come down and they fill in, there's overflow capacity to watch on the big screen in the Deer District to support the local Milwaukee Bucks. Once again, the reason why San Bernardino doesn't have a Deer District of its own isn't because it isn't big enough. It isn't because the market can't support it. It's because of placemaking. It's because there's not quite the density of services in downtown anywhere in this region that can support a stadium and all the things that go along with the stadium throughout the year. How does the Inland Empire build a major league downtown, or 3? We've got 3 major cities here. Why can't we have 3 major league downtowns? And Major League Downtown here, of course, stands in not just for a downtown that can support major league teams, which is, of course, very important to many of us, but one that can support major league amenities of other kinds, operas, ballets, symphonies. Why can't the Inland Empire take its place among other major metropolitan areas in the country? And what I want to do as I try to answer this question today is talk in terms of strategic objectives and tactics. The strategic objectives, I will argue, are pretty clear. They're pretty well known by urban economists and urban planners, and those are the twin goals of residential and establishment density. We want lots and lots of people in a relatively small amount of space in our downtown areas, in our urban cores. Now, how we get there is something that is debated more and something slightly more of an art than of a science. But I'm going to give you some examples and some ways we're thinking through building density at the center. And these are establishing anchors, public safety, and producer services. But before we get in there, let's talk a little bit more about density. Let's really drive this point home. Here are a bunch of metropolitan areas that are about the same size as the Inland Empire that all have iconic downtown areas. So Greater San Francisco doesn't really need to be said. We're all aware of the wonderful public spaces there. Greater Seattle by the waterfront, by the farmers market. Greater Tampa Bay, speaking of other championship-winning sports teams, after their team won the Super Bowl this year, you saw people convening in downtown areas. Baltimore, Pittsburgh, these are all places that are about as big as the Inland Empire. And they're places that have been able to ascend this density hill. And the density hill isn't necessarily having San Francisco level or Los Angeles level densities throughout the metropolitan areas, but at the very least having places where folks can convene when they want to express their civic pride. So the Inland Empire is big enough to host a major league sports franchise or other major infrastructure, but it's not dense enough. When you look at the metropolitan area size of an Inland Empire versus Seattle or Denver, you see comparable levels, or even you see that the Inland Empire is larger than these peer cities. However, when you look at the downtown of the Inland Empire, and the closest thing we get in terms of population or establishment density to the downtown of the Inland Empire is downtown San Bernardino, what you find is that the Inland Empire, in terms of the density of its downtown, ranks 66th in terms of population density and 119th in terms of establishment density among all metropolitan areas. So it's nothing like the densities that are on offer in Seattle, Denver, and Baltimore, some of its peer cities. Another thing you find is that the Inland Empire lacks top-end density. Here, it seems pretty complicated, but it's not very complicated. It's a cumulative density distribution. It means as you go on the x-axis from more and less dense type of neighborhoods, you are adding to the sum. And by the time you get to 100% in the yellow bars, that's the San Bernardino area, both now and in 2003, you are at much less densities than in the peer cities. Now, what this has to do with, and this ties back to something that Tanner was saying, is the knowledge end of the job space here in the Inland Empire. It's not so much that the Inland Empire does not have high-end knowledge workers, but that more often than not, those workers need to commute in to other areas in order to access those jobs. There's not quite enough of those jobs in the Inland Empire, and by extension, there are not quite enough of those jobs that are demanding density. So when you're thinking about high-end services like legal services or accounting services, those tend to cluster, as we say, in downtown areas. They tend to require more density, and simply because the Inland Empire does not have those jobs, it does not have the demand for the sorts of dense urban environments that we've been celebrating up till now. But we can't just talk about establishment density. It's not just enough for there to be a lot of law offices and accounting offices in a downtown area. You also want the sort of place that people want to be late at night or on the weekends. And what we find when we think both in terms of residential and establishment density is that on average, these tend to go with each other. The more residential density you have, the more establishment density you tend to have, and vice versa. And on this chart, if you think about the top right cities on this chart, those are the cities with the most dynamic downtowns. The New Yorks, the downtown Miamis of this world tend to have high residential density and high establishment density. So this is really when we're thinking about strategic objectives for placemaking in the Inland Empire. These are really what we're setting our targets on. Now let's talk a little bit more about the benefits of each type of density. On the residential density side, what you want, the reason why you want to bring in more people per square mile in a downtown area is you get more of that 24/7 energy. The sorts of people that are attracted to cities at night tend to be younger and maybe more vital than people who are attracted in the day to work at jobs. So you want to take advantage of that youth and vitality. Same for the demand for arts and music. If you are a believer, as I am, in the power of arts and music to really activate urban space, then you want to attract folks who want to patronize arts and music. Sales tax. People are spending more money at night and on the weekends than they are during the day, so you're trying to bring in residents to downtown areas to create sales tax support. Now, all of this is going to be relatively more important in the current post-crisis period than it was before. And that's because of the work from home changes that we heard about in the last presentation. As there's less people, relatively speaking, or at the very least, less demand by some types of offices for downtown areas, it's going to be more important, relatively speaking, that those same areas can attract residential density. But we can't lose sight of establishment density. We can't lose sight of establishment density, first of all, because of the tax receipts, the tax benefits of that kind of density. But also, when we're talking about dynamism in urban areas, business travelers make a big difference. Business travelers make a big difference because they bring expense accounts, they bring demand for hotels, convention centers, these sorts of things. And if you can build up an establishment base in an area, an establishment base especially of producer services like law offices and accounting offices, then you can also create a demand by business travelers to come into those areas for meetings and interactions. We also can't lose sight of new businesses. New businesses tend to form where old businesses are. They tend to want to trade with old businesses. And so if we want the new and most exciting parts of the economy to be located in the urban areas of the Inland Empire, we need to think about how to establish current levels of establishment density to draw those in. And this is going to be relatively less important post-2020, but it will not be important. It will continue to be important to have a tax base and all these other things as we move forward. And I do want to point out that we don't have to have as our model a New York or a Chicago or a Seattle when we're thinking about how to build establishment and residential density in the Inland Empire. Orange County has been able to generate certain levels in small areas of establishment and residential density, and they can be a model. We can do it better. We can do it bigger and better here in a relatively suburban area than Orange County did. Now I want to talk about how. I want to talk about the actual levers that we might be able to push right now as a region that does not quite have the establishment density or residential density that we want in order to get where we want to be, and that is a major league metropolitan area. It's very tricky, actually, to think about how to strategize around density, because density is a kind of chicken and egg problem. For one, as I've said already, residential and establishment density tend to go together. You get residential density when there's a lot of jobs. You get establishment density when there's a lot of residents, because jobs want to be near residents and residents want to be near jobs. In terms of the actual mechanisms towards getting density in a region, I want to talk first about anchors. And the reason I want to talk about anchors is because they help to resolve this chicken and egg problem. Well, what's an anchor? An anchor is a big establishment like a university or like the headquarters of a corporation that can immediately draw in workers, and those workers can immediately demand housing around where they work. So traditionally, government jobs have been very attractive anchors. And when you look at some of the anchors that currently exist in the Inland Empire, you find that the government has provided a lifeline. Governments like the County of Riverside or the County of San Bernardino. However, these aren't enough. government anchors will not be sufficient for generating the kind of dynamism that I've been describing because they have fixed schedules, because they have low growth potential, because they have less spin-off potential. What all of this means is that the size of the government is basically constrained by the number of people you have in a local area. There won't tend to be more government or additional governments spinning off from the existing government. So there is not that forward-thinking dynamism. A suitable anchor will be non-governmental, not necessarily for-profit, but non-governmental. It will employ more than 500 full-time staff, and it will have strong linkages to the local business community. Now, another anchor that's traditionally supported the development of downtown areas is the retail sector. So initially this was markets. This goes back the whole history of cities, but there's also been department stores and malls. The Inland Empire learned relatively early, 40, 30 years ago, that retail doesn't last forever, that you can't, for time immemorial, build a downtown around department stores. Department stores used to be a much bigger part of San Bernardino's urban life, and they no longer are. Increasingly, as we heard from Tanner's presentation, other areas are learning this lesson, that the switch to e-tail from retail is going to lead to certain shocks in the economy. So as the city of San Bernardino, the city of Riverside or Ontario look to anchors and identify anchors that can support new rounds of density in their urban cores, they need to look to other amenities, wages and income, and residences in order to do this. Now, luckily, you aren't starting from scratch in the Inland Empire. There are 3 natural anchors corresponding with 3 already strong urban centers in the Inland Empire of Riverside, San Bernardino, and Ontario. And luckily, from the standpoint of stamping out some of the unhelpful urban factionalism that you see in some economic development projects, these anchors sort of complement each other more than they do compete with each other. So you've got this fantastic anchor that I'm delivering this presentation from at the University of California, Riverside. In Riverside, you've got the county seat in San Bernardino. You've got the airport in Ontario. These are major employment anchors that can help to strengthen density in and around these urban economies. And an anchor-driven strategy is going to figure out ways to provide linkages between the downtown areas and these anchors. One example of an anchor-driven strategy might be to ensure that new dorm development at UCR is anchored to the downtown area. You get dorm rooms, you get college students in a downtown area, you're already going to make that area a more 24/7 and vibrant area. So the city of Riverside and the region of the Inland Empire can look to its current assets in order to generate some of its density. But we can't just rely on outside saviors in the form of anchors to do some of this, to do all of this densifying for us. Public safety is important. And when we talk once again about the currently most dense area of the Inland Empire right now, what we have is an area that is significantly less safe than other downtowns, even in the density cohort of San Bernardino, and even more less safe than leading downtown areas across the country. At the center, we did a small study among the 100 most underperforming downtowns, and we found that crime per capita is associated negatively with establishment density. So what you want to do in order to turn the ship around is do the things you can to get more eyes on the street. This can sometimes take the form of ambassador programs in downtown areas where you pay for more people to monitor the street. The great urbanist Jane Jacobs emphasized eyes on the street as a precondition of safe urban areas. And you can look to case study evidence as well. We identified in our research Cary, North Carolina, as a exemplar of making an area more safe. Its establishment density grew by 21% between 2007 and 2016, and its crime fell by around the same amount, 20% in that same period. So there isn't a complete cause and effect here. Some of this is a chicken or egg problem, but clearly some part of the turnaround of Cary, North Carolina had to do with public safety, and anchors didn't help either. There are 3 strong anchors in SAS, MetLife, and Verizon in that city. Finally, I want to return to producer services. It's been a small theme throughout this presentation, but when we want to talk about having more establishments per square mile in a downtown area, what we're really talking about are producer services. Sometimes these jobs are called FIRE, finance, insurance, and real estate. There's other acronyms for them, but it's really important to have in mind the consumers of density when you want to build more density. Now, this is especially true in legal services, but unfortunately, things are moving in the wrong direction in downtown San Bernardino for legal services. The number of downtown law offices, based on our study of the topic, actually dropped from 56 to 31 between 2009 and 2019. Whether or not this has to do with public safety or something else is the subject of a research project we'd like to pursue, but it's clearly a troubling development from the standpoint of developing more density. And it's also troubling development for the hospitality and service businesses in downtown San Bernardino that would service law offices. Ultimately, and some of you might laugh at me saying this, there aren't enough lawyers in downtown San Bernardino. San Bernardino is not making the most of its current assets, its current anchor, which is its county seat. Fewer lawyers downtown in San Bernardino than even in Riverside, and even in Riverside, there's not a ton of lawyers downtown. And maybe most troublingly of all, if you look at all the lawyers in San Bernardino County, only 25%, 1/4, are in the city of San Bernardino at all. So in order to build density, you can start to think about building more law offices, targeting directly lawyers and other producer services to come downtown. I could go on. There are different areas of the playbook to increase density that we haven't explored yet, but time is short, and I think I should just go back to talking about basketball and Major League sports. The Milwaukee basketball team, the Milwaukee Bucks, happened to win the championship this year because they had a guy named Giannis Antetokounmpo powering their offense and defense. Giannis Antetokounmpo is a rangy 7-footer who started playing basketball late in life, but was kind of always meant to be a basketball player, if not a professional basketball player. And lo and behold, he was. For the same reason, the Inland Empire is kind of meant to have a major downtown or 3. It's got 5 million people. It's got over 1 million jobs. It is a major economy in the country. However, it does not quite have the place, it does not quite have the urban environments necessary to sustain density and sustain some of the wonderful things about urbanism. We need to embrace density as a goal, spark it with anchors, public safety, producer services, and other things that I haven't had time to talk about. And then we need to watch what happens. It's going to be great. Pass the popcorn.
Thank you, Patrick. We do like our downtowns, don't we? There's so many iconic ones. I'm glad to hear their demise is not imminent. Today's presentations and forecasts have generated quite a few questions from our audience. At this time, I'd like to ask Chris, Tanner, and Patrick to join me, and we'll attempt to answer as many as possible. We do have a number of questions, and I want to get right to it. Chris, you mentioned that vote buying and politics have contributed to inflation. Mike M., like many of us, me included, want to know, do you see the national debt eventually causing serious problems to the U.S. economy?
Right. Well, two things to keep in mind there. The inflation is a combination, of accelerated over-the-top consumer demand driven by the trillions of dollars they poured in the economy, but it's also a function, of course, of the massive increase in the money supply. It's kind of a 1-2 thing. Now, right now, the U.S. has about 128, 127% gross debt to GDP ratio, one of the highest ever. But candidly, a number that doesn't necessarily imply some sort of fiscal doom down the road at some, we just don't know, particularly for an economy as big as the United States. For me, the risk is less about, shall we say, the bond markets getting really scared about lending more money to the US government, and more about, if you will, the back and forth between interest rates and that debt. Remember, the federal government got away picking up all that debt over the last 20 years because interest rates have come down and the debt burden, the debt payments to GDP ratio has not budged despite that doubling of debt to GDP. Well, eventually, we saw the numbers this morning. We got a 6.2% inflation rate, highest in 30 years. It's not slowing down the way that Jerome Powell has been promising. And at some point, again, those bond markets are going to have to react. Interest rates start going up. The Federal Reserve has to react. They start tightening up base money. And the next thing you know, the cost of that government debt goes up. Now, that's where it starts becoming ugly, because then we get into the feedback effect, which is to say the cost of servicing the debt's going up and it's making them borrow more. And you get into this feedback loop that can cause big problems down the line if we don't get in front of it. Hopefully, the US government won't do a Greece thing and just, hear no evil, see no evil, speak no evil until it becomes a disaster. But regardless of how they handle it, we know at some point out there, they're going to have to turn off both the monetary and the fiscal spigot. And then the question is, how do we land? What happens to the economy at that point in time? There's a lot of risk out there, but again, this time it's on the public side of the economy, not the private side.
Another very closely related question from the audience: how much purchasing power do you think the middle and lower class will lose as a result of this rising inflation?
I've been getting that a lot lately, and let me sort of repeat one of the points I made in my presentation. Consumer demand is driving inflation. It's not hurting consumers. Inflation isn't hurting consumers. It's this excessive amount of demand driven by $29 trillion in household net worth creation that is causing prices to go up at this particular point in time. Now, there are absolutely families on there that are not beneficiaries of the rise in the stock market, the rise in home prices, that maybe were hurt over the course of the last year because of the pandemic situation. And yeah, they're the ones who are suffering, particularly if they're on some sort of fixed income. But overall, most of the economy is in great shape, which is why this economy is taking off this way and why these price increases are so bad.
Thank you. Tanner, question for you. Is there any forecast data specific to the high desert?
Right now, and actually Chris will probably know better than me. He's in charge of the forecast, but I don't believe we have a working forecast for the high desert at present.
Okay. Well, let me move on then. One of our audience observes, and I certainly don't disagree, there's a small business crisis. Can any of you address the factors that have caused big businesses, or at least many of them, to thrive, while many small businesses have just died?
Well, I could take a pass at that, but I think Patrick might be, I see him chewing on it too.
I mean, all I'd add is, when we think about the complete transformation in the rules of the game for a lot of small businesses in March of 2020, there were some businesses that just didn't have the investment capital available to go over to a completely online form of retail, or upgrade the fiber optic facilities, these kinds of things. I think if you look into the data, that would bear out somewhat, and I think that's consistent with what the commenter is saying.
But actually, I'm going to address something slightly different about that question, because there seems to be a narrative behind there that somehow or other small business has truly suffered. And I want to be clear. There's no doubt that economists have worried a lot, if you will, about consolidation. Take, for example, in big tech, right? Every time a tech company gets off the ground, they get to a certain side, boom, Google, Facebook, Microsoft, someone buys them, right? And they keep consolidating power. And in a lot of ways, the venture capital game is basically based on that. Let's build a company and we know what they're going to buy as soon as we have 300 people. But what that is really talking about is the monsters versus those big potential entrants And that is where you're losing competition. On the other side of it, when you go to the truly micro scale, actually small business is flourishing better than ever before. Think about the world of your standard farmer's market, where now everybody has their iPad with a little credit card swiper, and they're able to be a small business by having that device sitting in front of them. It's a different game for the truly small folks out there. Anybody who's listening to this conversation right now, you want to start making 25, 30 bucks an hour, Tanner will tell you all about it. You go you go download Lyft or Uber, and bam, away you go. So truly micro businesses, the gig economy is flourishing more than ever before. It's really all that, again, the entry-level monsters and the monsters where we see that diminishment of competition that worries a lot of economists.
Well, I appreciate that. Let me move on to the next question. You mentioned that you think the U.S. oil production will increase and that will somehow improve. Do you really see that occurring when the national government has endorsed, or at least certain parts of it have endorsed, the Green New Deal, and Governor Newsom has recently declared that oil production in California has no future?
Well, Gavin Newsom may say what he wants about oil production in the state, if you will, but when you're thinking about the national situation, it's not California that's been the swing producer. It's North Dakota, it's Texas. These are well-established oil fields. A few years ago, they discovered, I think it's called the Wolf Shale, Wolf or Eagle or something like that, an enormous deposit of oil that is accessible via fracking. And these oil fields already exist. It's not about exploration. It's not about opening up parts of Alaska. That oil's sitting there. And the only thing they had to do is put straws in the ground. Reality is the numbers are very simple. 50, 60 bucks a barrel. It makes sense to start fracking again. Now they're waiting to see how sustainable it is. They're not going to go spend a bunch of money if they think this thing is a flash in the pan. But when it kicks in, they're going to be out there putting holes in the ground again. And I fully expect that, yeah, oil production in the U.S. is going to go up again, like it or not. Now, for those who are thinking about the Green New Deal and we have to cut back on fossil fuels, I agree with you. I don't have a problem with that. But until we get a grip on what I would call demand, what are we going to do about it? I mean, look, we want all cars to be electric, but we don't have an electric grid that can even handle that yet. So we're going to have to make a lot more investments as a nation before we can just cut off, if you will, some of these residual fossil fuels. And I hope we make it, but at least in the near term, we're still dependent on this stuff coming out of the ground.
I certainly agree with that. Tanner, one of our other audience asks, how can we coordinate with cities, counties, developers, and businesses to make sites available within the Inland Empire to store containers offloaded from the ports to alleviate the current supply chain delays?
Yeah, I think that, in the short term, I think that's probably a little bit trickier than sort of expanding capacity over time. I think over time, the region has done a great job at making land available to absorb capacity from the inflow of goods and containers from the port. So I do think that in the short term, it's all hands on deck. We have 24/7 ports. I'm not sure we can sort of click our fingers so quickly and just sort of open up land for containers. But I think in the long term, I think the region's done an outstanding job of incorporating this this economic beacon that it has on its doorstep.
Dan Taylor asks, the Inland Empire is in the top 5 most filmed regions in the state. He says probably within the top 3, and that during the pandemic, filming in the IE increased due to the large amount of open space that's available for filming. Do any of you see or have a view on how the film industry has impacted the Inland Empire during the pandemic?
Well, I'll make a plug here for downtown revitalization. One of the things that, as I said in my presentation, that we're really thinking through is what are some anchors for new types of like higher value services in the Inland Empire. And I think film represents a really interesting case. There's shooting, of course, and every jurisdiction all over the country is thinking about how they can get more shooting. But we really think that more can be done in the Inland Empire, like post-production, management, even executive function. A lot of these, if you're a small film production house, let's say, are priced out currently of Los Angeles, yet being in the IE gives you a lot of access to Los Angeles that you would prefer for a lot less cost. Plus you get to take advantage of a lot of, not just the shooting locations, a lot of the other amenities out in the Inland Empire. I think it's a real candidate for some anchor-driven development.
Well, that's certainly encouraging. We got two questions. Go ahead. Sorry, Chris.
I couldn't agree more, Patrick. I think that's an absolutely brilliant comment to make. But I will say that when it comes to the entertainment industry, you have to go to them. So at some level, the industry has to have what I would call a succinct strategy. They have to have a czar. They got to have someone to make that outreach. This is an industry that expects you to go to them. And as such, the Inland Empire does absolutely have, as Patrick said, they should be an obvious, but you're going to have to go ask.
I think that's a good nudge for us. We got two questions about housing. First, how many housing units and at what price point and size do you think would be needed to construct sufficient labor supply housing for all of the Inland Empire sectors, labor force sectors?
Tanner, you want to take a swipe at that, or?
Well, let me add, I've heard like what the statewide, we're told we need 1.25 million new units. How much, first of all, do you agree with that? And how much of that do you think we need in the Inland Empire?
This is one of those, how many angels can dance on the head of a pin argument, right? I mean, we know we need a lot more housing than we have. I think I've seen numbers 2 million, 3 million. We have a shortfall of 1 million. How do you actually come up with that number? How do we account for all the families that are already left, right? The point here, as opposed to picking a number out of a hat and pretending it means something, can we just acknowledge that what we need in this state is a lot more housing, and particularly what I would call entry-level market rate housing, a lot more multifamily. We're very good at building single-family places up in the hills, but for some reason, it's really tough for us to build enough multifamily space. The resistance to it is palpable in many communities, even communities that are so dense already, you think it would be a logical place. They have, 3 families living in one house, but we just can't seem to break the logjam on that issue. And between you and me, I don't think ADUs is the fix.
Well, I think related to that, Zaire Marin asks, to what extent do you think NIMBYism is hindering development within the Inland Empire, especially as it relates to high density and mixed use developments?
Yeah, so there were a couple of questions about multifamily housing specifically, and I think that there's a relationship between the multifamily conversation and some of the sort of downtown redevelopment stuff that Patrick has been talking about. Typically, we find a lot of multifamily housing in sort of dense urban areas where you have a greater mix of use in zoning, where people aren't as necessarily reliant on cars in order to undertake their daily activities. So I think that the broader conversation about multifamily housing does sort of directly relate back to this idea of sort of densifying certain parts of the region, because the reality is, multifamily units work best, for lack of a better term, when we have these sort of denser urban cores.
Well, one of our viewers also asks or observes that the number of multifamily housing permits has declined in recent time as compared to prior years. What do you think has contributed to this decline?
I think statewide, generally, I think the Inland Empire has been sort of tracking sort of the statewide trend to a much greater extent over the last 4 or 5 years, and I just think generally it's a region which has absorbed a lot of population over a 20-year period, and there's going to become a time when that growth rate is going to start to slow down a little bit, and it's going to take a lot of concerted action in order to And again, I hate to bring it back to sort of the downtown conversation, to put in place sort of region-wide plans with respect to how we're going to absorb different types and tenures of housing over the next decade.
And multifamily really has never been a big part of the housing stock situation out in the Inland Empire. It's been a largely single family market. They've always touted themselves as a suburban kind of economy. But the world's changing. I mean, you heard what Tanner had to say, what Patrick had to say about densification, the need for it, about building downtowns. And that means a shift in focus towards job density and housing density in a way that region just hasn't sort of done in the recent past, you know, and it's a change in attitude about things. And, you know, change in attitudes are often tough.
I certainly understand that. And this is a question I have to follow up on that. Do you really do you have any thoughts as to whether SB 9, the idea of tearing down single family units and building 2 duplexes, is a viable solution either in the Inland Empire or elsewhere in the state?
Tanner, Patrick, you guys want to?
I mean, I think you need more flexibility. You want to give municipalities that have appointed themselves to densifying more tools in the toolbox to do that. I think there's some places that have struggled with those goals when, you know, existing zoning structures just don't permit that. So I think it's on net probably supportive. But with any of these things, I think we too much tend to think in terms of silver bullets, and I don't see any single zone as something that's going to lead to density. The greatest challenge in the Inland Empire, and indeed many other places, is in generating demand for it. You need more demand for the land. Zoning is just kind of a smaller part of that.
There are some places like in for example, Rancho Cucamonga, where they tend to have larger lots, which is maybe a little more helpful out in those kind of communities relative to, say, I don't know, West LA, where lots are pretty small, they're postage stamp size. But again, as Patrick was saying, it's the question here is one of sheer scale. Will enough people be willing to do that, to tear down your home, to build up something else that can really move the needle on this thing? And I don't think so. I mean, we're far enough behind that we need something bigger.
What is your forecast surrounding the supply chain issue in 2022 in the near term?
Our best guess is this thing's going to clear up in the spring. I mean, look, one of the reasons it's so chaotic right now is we're coming into the holiday season. Spending is going through the roof as it is. You know, I like to point out that in every single year we have a recession. It starts on January 2nd and goes till about late March. There's a tremendous decline in spending activity. What's interesting, I mean, it's a truly dramatic decline in economic activity, one that you wouldn't believe if you actually looked at the seasonally adjusted numbers on GDP. But we have it built into our systems. We have it built into our profit zones and how we invest and how we hire. And so we don't really think about it, right? It's just nothing. It's just used to it. But that's exactly when we're going to have the ability to allow things to catch up, to get in front of it yet again. And hopefully next time around, we'll be a little quicker off the dime, if you will, to make sure we don't fall this far behind.
You mentioned that certain sectors of our economy are having a difficult time getting people back to work. Obviously, everybody realizes that, and also that people have choices. But from a policy perspective, do you have any suggestions how we fix that, how we get people back to work, how we in fact fill those jobs that are still woefully vacant?
Yeah, well, look, again, think about the numbers. In the last year and a half, the labor force has contracted by 3 million people. That has never happened before. In the Great Recession, when we had highly elevated unemployment rate for years and years, when it was absolutely at its worst, the labor force had contracted by a little less than 1 million people. And that was purely discouraged workers. These aren't discouraged. There's nothing to be discouraged about. We've never had so many job opportunities. Of that 3 million people out of the labor force, well over 2.5 million of them have retired. They don't want to work. they feel comfortable not working. And by the way, their home went up in value 20%. They refied at 2.5%, which means their mortgage payment went down. The government gave them a ton of money over the last year. Oh yeah, and their stock market portfolio is the highest it's ever been. How do you get these people back to work? We could take their money away from them. Now, my understanding, of course, is that's not legal. And so ergo, we may have to figure out some other solutions. In other words, it's not so much about bringing people back to work because they're largely gone. The real question is, how do we expand the labor force? And on that front, there's, again, 3 ways of doing it. Figure out how to get seniors who do want to work back in the labor force. B, invest in pre-K education so women can be a more important part of the labor force than they are. If you look in Europe, across Europe, female participation rates in the labor force are vastly higher than they are here. And that is because of the subsidies of pre-K childcare. It's as simple as that. It's not a social conversation. That's what I try to get across to people. Pre-K education is good for the kids. It's good for the moms. It's good for the families, and it's good for business right now. It's probably the most obvious policy decision this nation should be making. And the fact that we're tiptoeing around it, to me, is a little silly. And then, of course, last but not least, it's that age-old mantra for 40 years. Will somebody please fix immigration? It's been a disaster since the 80s. We know we got to reform it. And we can't get anybody in DC to do what they need to do.
Amen to that. Amen to that. More labor-related questions. How do you see the end of student loan deferment in January impacting the economy, if at all?
I mean, classic economics textbook, right? Like it changes the budget constraint a little bit, right? Beyond that, I don't know. I mean, I think if there's one thing we've learned in the past year, and we had a presidential election about a year ago where I think it was unknown whether or not there would be any student loan deferments. I'm going to go out on a limb and say that ship has sailed, and there will not be.
Well, and even if they did, look, let's say I think they did talk about cutting like $10,000 or $20,000, like just forgiving some of it. I'm not sure what they may do or not do. To Patrick's point, maybe that ship has sailed. But let's be clear. What people don't talk about when it comes to student loan debt is most student loan debt in the United States is not with low-income families. It's with doctors and lawyers and people with professional degrees that cost them hundreds of thousands of dollars. Those families, for the most part, are making tons of money, and they certainly don't need to have their loans forgiven, as the case may be. It was a great investment for that family, and they're doing fine. Others, for those lower income families, will this help them? Yeah, it'll give them a leg up, and candidly, I'm okay with that. I think that that's perfectly fine, but it's not an economic panacea. Look, right now in the United States, we have major labor shortages, and I'll tell you one of the things that does now more than ever is it gives people who have not had opportunities in the past opportunities to succeed in this economy in ways they've never thought. Now more than ever, worker training, funding our community colleges, making sure that we take people who are on the margins of the labor force and give them the skills necessary to be a productive part of the labor force. Again, that's good for everybody.
We have a couple last minute questions really deserve to be asked. Do you think water availability will limit economic growth, first in the state and then more particularly in the Inland Empire?
It depends on what we think is more important, roofs or hay. We don't have a water shortage in the West. We have a water consumption problem. We are putting a tremendous amount of water into the ag community. And while, listen, it's an ag needs water at some level, but we're not asking that sector to be subjected to, if you will, some of the same sort of pressures that the rest of the economy is right now. In the last drought, even in the worst years of the last drought, you cannot believe how much hay we grew in California, of which, by the way, about 30% of that hay was put on boats and shipped to Japan and Korea at incredibly low prices. We were exporting water in the middle of a drought. That's crazy. And what's amazing to me most about this is, look, we're a nation that believes in the market. We love markets. We're a capitalist economy. We're proud of that. We go around the world and we preach to the world the importance of markets, and you too should let markets drive your economy. But for some reason, when we mention the idea of maybe having a market for water, people lose their minds. To me, it's an odd state of affairs. And if we're going to fix water in the West, we have to start with the idea of why is it broken in the first place? And the answer isn't because there isn't enough of it. We got a lot of water out here. We just got to be a little smarter about how we use it.
Gentlemen, what are your thoughts regarding Bitcoin and cryptocurrency as relates to everything we've talked about today?
Does anybody remember Beanie Babies? I'll stop there. Patrick, Tanner, if you guys want to take a shot at blowing this up, please do.
I mean, I just wish I'd bought some when Bitcoin was 500 rather than wait until today.
That's true, and I wish I picked those right lottery numbers last week. In the Cal lottery. Look, we already have an electronic currency. It's called the U.S. dollar. 99% of dollars are virtual. There's nothing particularly unique about Bitcoin except for the fact that because it's a virtual online currency made by a private source, it's not as easy to trace to the Russian gangsters who are demanding it to unlock our data. It's a nonsensical idea. And me personally, I wouldn't touch it with a 10-foot pole. Yes, it has value now. It may have value for a very long time, but there are no fundamentals there. If you want to dance in the clouds, maybe you'll find heaven and maybe you won't.
Just try not to be so equivocal, okay? Just tell us what you think.
David, here's all I'll say. Bitcoin, and without contradicting anything of what Chris just said, I think what you're seeing is that the regulators are being a little bit more tolerant of electronic regimes now than they certainly would have been absent Bitcoin. So you are starting legitimate sanctioned Bitcoin kind of lights coming out. And I think that's probably going to be good for the economy and good for the gaming economy. But yeah, as an investment, you guys should buy tutoring sessions with each of us before you buy Bitcoin.
Keely Leung asks, is 6.2% the current inflation rate?
Yeah, that came out this morning. 6.2% year over year increase in inflation. Core rate was about 4.2, 4.3%. That gets rid of food and energy. However you look at it, it's the highest number we've seen since 1990.
What's the chances we experience hyperinflation within the next 5 years?
Nah, it's not going to happen. The Fed's a little bit out of control, but they're not that out of control. And they still have some functional separation between, if you will, the Congress and their spending and the fiscal authority. The way you have hyperinflation is when the government starts printing money to pay the bills. And right now, our government still can't do that.
Okay, well, I really hate to do this because this has been very interesting and certainly educational for me. I hope everyone else, but we are out of time. And with that, I can't thank our panelists enough. And again, on behalf of the University of California School of Business, the UCR Center for Economic Forecasting and Development, Chris, Tanner, Patrick, myself, and all the dedicated UC staff who made this year's virtual conference possible, I want to gratefully acknowledge and thank our sponsors. Again, our gold sponsors listed here: Bank of America, Hall & Knight, Riverside County Office of Economic Development, Pacific Premier Bank. Our silver sponsors: Altura Credit Union, the KPC Group, SolarMax. Our bronze sponsors, our media sponsors, our in-kind sponsor. Literally, without their support, for the university and our entire community, we just wouldn't be here. And to you, our attendees, thank you sincerely for joining us. We're all in this together, and I hope, like you, we're all excited and cautiously optimistic about our long-awaited escape from what Chris calls miserableism. I'd never heard that before, but I think that's certainly very, very true. Here's looking to our all getting together next time in person. And until then, happy holidays, stay safe, and stay healthy and prosper.